I'm Yahoo Finance Executive Editor Brian Sozzi, and you're taking a look at a live shot of the opening bells on Wall Street on this Monday morning. Make-A-Wish ringing the bell at the New York Stock Exchange, and CTW Cayman, a gaming platform company, getting things popping over there at the NASDAQ. Now, there will be no shortage of market-moving events this week. Ukraine President Volodymyr Zelensky will be back in Washington after President Trump met with his Russian counterpart Vladimir Putin last week. Other European leaders will also be at the White House, namely French President Emmanuel Macron and Italian Prime Minister Giorgia Meloni. The market will have to keep its head on a swivel as this meeting coincides with the start of the Fed's Jackson Hole event. Investors are holding out hope Fed Chair Jerome Powell signals a September rate cut. Now, opening bid is all about serving up investing analysis you need to know to unleash the power of your portfolio. We're digging into what's really moving stocks, giving you the unbeatable context to make decisions with all that money in your portfolio. Let's get a quick check of the markets out of the block here. Yahoo Finance senior reporter Brooke DePalma is at the NASDAQ in Times Square. Brooke.
Good morning, Brian. Markets are largely flat as yet again we head into this week where we're getting that key speech from Federal Reserve Chair Jerome Powell on Friday from Jackson Hole. This will be his last time going and joining and saying a speech at Jackson Hole. He's set to end his term in May. But if we take a look, all three major indices roughly flat as we make our way into the morning open here. The NASDAQ up about 0.02%, really on the flat line, as well as all three major indices also on the flat line. As Ed Yordani said in a note this morning, markets are waiting with bated breath ahead of that speech on Friday, and you could really see that playing out here. Also, we just had a guest, Dana Dioria from Investment Solutions, saying that the market is doing what it always tends to do and kind of leaping way ahead of this expected interest rate cut come September. Right now, markets are pricing in a more than 80% chance that we will see an interest rate cut come September by about a quarter point. As you can see here, once again, all three major indices flat, but I do want to take a look under the hood. We do have some key earnings reports coming out this week from Walmart, Home Depot, Lowe's, Target, as well as Ross and TJX. And right now what we're seeing, if you take a look at where we're opening this morning, despite the fact that we are expected to see a negative same-store sales print from Target, investors are turning to that stock this morning, intraday trading about up 2%. We also know that Walmart is suspected to outperform yet again as we make our way, and they really double down on that convenience and pricing model that has really held on to the momentum. Right now, that stock above $100. Lowe's also reported home improvement retailers set to really see a positive reverse to the upside this week. Right now, that's in the red, as well as Home Depot down about 1% ahead of their key reports out this week. And I also want to take a look at the NASDAQ because despite the fact that we've heard from so many AI companies, NVIDIA, we are still waiting to hear from their report out next week. That stock getting a bit of attention, up about 0.5% in this early market open of this Monday morning. Once again, though, all three major indices on the flat line here as we await that key speech come Friday. Back to you, Sozzi.
Brooke, is earnings season ever going to end? When does it end? It just keeps going on. It just needs to end. All right, Brooke, we'll check back with you in a second. I'm kicking things off with your daily guide to the biggest market drivers of the trading day. Here's what I'm watching. Number one, the bulls are banking on not being fed up. Fed officials will look to do some fly fishing at a stuffy old lodge in Jackson Hole, Wyoming this week. All the bulls hope they catch as a fat signal on a September rate cut from these mostly outdoor enthusiasts with stocks at record highs. Centerpiece of the Jackson Hole meeting this week is Fed Chair Jerome Powell's speech on Friday, where he could signal that aforementioned rate cut. Powell has used his speech as a clue dropper on rates in the past. Last year, don't forget, he signaled a rate cut was in the offing soon. The Fed went on to cut rates at its September meeting and then again in December. Number two, retailers are on the clock. Earnings and outlooks this week from Target, Walmart, Home Depot will give clues on how consumers are navigating tariffs from the Trump administration. They will also go a long way in showing if big retailers are raising prices because of tariffs and how that may play out for the crucial holiday shopping season. The results could vary widely. Target is slated to report another terrible quarter, in part as its prices are seen as too high. Walmart's low-price messaging is stealing market share from Target. And Home Depot may have gotten a slight tailwind from mortgage rates falling from their highs. On the opening bid roundtable for today, Callie Cox, Ritholtz Wealth Management Chief Market Strategist, and Yahoo Finance senior reporters Brooke DePalma and Inez Ferre. Callie, I want to start with you here. The Fed, I think the market is really expecting this rate cut from Jerome Powell. Do you think we get it from this Jackson Hole meeting this week?
I think think we get some indication of what we're going to get in September, Brian. I am not so sure that we're going to get a rate cut in September, at least not as sure as the markets, which are baking in an 80 to 90% probability through Fed fund futures that this will happen. I'm actually interested in hearing what Fed Chair Powell says about inflation, because I think that's the tricky detail here. Inflation numbers on the goods and services side are moving up again. And in that context, a rate cut doesn't really make sense. So for Powell to push ahead on a rate cut tells me that there's an air of desperation there.
So you think the market is set up for disappointment?
I think that's the risk. We'll see what happens. It's an unusually tricky time for the Fed right now. There's also a lot of pressure, of course, from the administration, but from the Fed voters themselves. I mean, there were 2 dissents at the July meeting when the Fed opted not to change rates. So I'm really interested at the underlying details of what Powell says, and he'll probably invoke some analogy about the stars or the ships or, something colorful come Friday. But he's going to have some messaging below there. He knows that people are watching for a rate cut come the September meeting. And, I think he's going to have a hard time at putting these pieces together.
Inez, I'm feeling a little bit sad here. This is Jerome Powell's last Jackson Hole Symposium. I mean, pour one out for Jay.
It is. And look, everyone is going to be watching this because of the importance of what he's going to say, really, and where he's going to guide the markets, so to speak. But I will say that some of the commentary that I've also been hearing is that because it's also his last symposium at Jackson Hole, and because he is going to be leaving soon, it does beg the question of whether he's also protecting his legacy. I mean, the Fed is really caught between a rock and a hard place because of these issues, because of inflation and also the labor market, but also protecting his legacy because the market, sort of a lot of market participants feel that maybe the Fed was too late to raise rates when inflation was going so high. And so in this case, he doesn't want to lower rates so much because he doesn't want to lower rates if inflation is still hot. So doesn't want to appear political, caught between a rock and a hard place. It's a tough spot for him to be in his last symposium.
Callie, what do you think Jerome Powell's legacy will be?
That's a really good question, because he was the Fed chair that led us through COVID, but he was also the Fed chair that let inflation slip too high, and that ended up materializing into an inflation crisis in 2022. I've heard from a lot of people, and I've thought about this a lot because it really is a heady question, but I've heard from a lot of people that inflation legacies stick around a lot more than recession legacies. Everybody remembers Paul Volcker for really laying the hammer down on inflation. They don't really invoke back to Greenspan, or they do a little bit, but Greenspan and Bernanke, I mean, I feel like the legacies are a little more muddled there, but for Volcker, he was the inflation killer. So I wonder if that's in the back of Jay Powell's mind. He doesn't want to be the Fed chair that misses on inflation twice.
The inflation igniter, Jerome Powell legacy. But Callie brings up a good point, Brooke. You were talking at the top of the show, lots of big retailer earnings reports this week. And sure, they warned about inflation from tariffs in the first quarter, but I think it's these earnings calls that might give us a better flavor of how these tariffs are starting to impact really major retailers that import a large amount of their goods from overseas.
Yeah, there's 2 key things that I'm really looking for from Walmart, from Target, Lowe's, Home Depot. Lowe's and Home Depot largely trying to understand how interest rates played into the home improvement environment. Did consumers just sort of put past and say, hey, I got to do those DIY projects. I now have 2 kids after I've been waiting years to jump into the housing market. And so we'll expect to hear more from them on that. But when it comes to Walmart and Target, 2 key things that I'm really looking for is their inventory levels. Did they pull forward when we saw that reprieve in those tariffs on China imports and then come back? Were they able to sort of stockpile ahead of the key back to school and holiday season? Or did they overstock as they saw consumers maybe pull back more than they had expected? Another thing with that same regard is, what's their outlook for the rest of the year? Was Walmart yet again able to win over consumers with those low prices? Whereas Target, were they able to pull in those consumers with maybe their convenience, like they've said in the past. We know that they're a discretionary retailer. A majority, more than half of their goods are imported. And so it'll be interesting to hear how they're thinking about those inventory levels, but also outlook to the second half of the year, which include those key to holiday selling season as well as back to school. I
just need, Brooke, for Target to start selling me better fresh food. I mean, the meat doesn't look right. The fish is like packaged in this weird packaging. I can't take it anymore. Inez, but continuing what Callie was saying about this Fed symposium and what we may not hear from Jerome Powell, I look at Home Depot and Lowe's. Those stocks have run double digits over the past month because of expectations of rate cuts. If we do not get that, those stocks are likely to unwind.
100%. I mean, the market is really anticipating that we will get some type of rate cut in September. Just the size of it may be smaller than what previously had been anticipating. But look, when we talk about these retailers that are going to be reporting, as Brooke was mentioning, I mean, how much can the retailers pass on to the consumer? Right now, we are seeing that Wall Street basically is saying, look, companies are absorbing some of this, but later on, we'll really see what the impact of the tariffs are on the consumer. And if you take a look at a company like Target, which was downgraded recently by B of A, Target is in a position where it's not just the tariffs, but they're also underperforming on sales, on digital, when compared to Walmart. And that stock is down 24%. So that company has to really report better than expected. But I think that the tariff issue is going to be central in these earnings this week.
And now they're ending that Ulta partnership in 2026 with Target. I can't even get my eye cream in Target anymore while I pick up some of that not so great meat.
Callie, you don't need any.
Yeah, no, I need eye cream. Look, we ain't getting younger, Inez. Give me a break here. All right, Callie, last word to you. Interesting report on the job market this morning out of Goldman Sachs. They're looking now for jobs reports, I would imagine, moving forward of 30,000 increase on the headline. That's just not good. How do you think the market will interpret that if we get a number like that for the next jobs report in early September?
Yeah, on the optics side, no, that's not good. That's 30,000 jobs added is much, much lower than the average of about 180 to 200K jobs that we saw in the 2010s. A lot has changed since then. I mean, the labor force is a lot bigger, so you need to take these headline numbers in context. One thing I'll point out here is that the labor supply hasn't grown in 3 months. We haven't seen that since 2011. And because of that, there are fewer newly unemployed workers entering the labor force that the job market needs to soak up. In a weird way, that's good for the unemployment rate. That could keep the unemployment rate low. But I challenge investors to think about why this is happening. If the labor supply isn't growing, is that the best story for the U.S. economy? So going back to what Goldman said, it's certainly possible. I'd say a 30K print today is less worrying than it would have been a year ago, but at the same time, you need to think about the trends underneath. If the labor supply isn't growing, chances are the economy is going to have a tougher time kicking into higher gear.
All right, big thank you to the opening bid roundtable for today. Callie Cox, Brooke DePalma, and Inez Ferre. Appreciate it. Straight ahead, I serve up an exclusive chat with Chipotle CEO Scott Boatwright in today's Power Player segment. We'll be right back. Welcome back to Opening Bid. Throwing some cold water on one of the market's hottest stocks of the year. That would be Netflix, which has rallied 39% this year on the back of impressive earnings and guidance. The stock is down 2% since the company's July 17th earnings report, compared to a 3% advance for the S&P 500. Chatter in the market since Netflix reported is on the bearish side, focusing on how much upside there is left for Netflix earnings this year and how much of any upside is already priced in. JP Morgan analyst Doug Anmuth is out today saying Netflix's valuation is fairly balanced at current levels. He reaffirmed a neutral rating on the stock, or the equivalent of a hold. Says Anmuth on Netflix, quote, "There are some concerns on market share and viewing growth." All right, Chipotle finds itself at a crossroads. The company is dealing with more cautious consumers and new upstarts such as Cava, and now it's looking to pick up the pace on menu innovation and new restaurant equipment. I caught up with Chipotle CEO Scott Boatwright in a new episode of my Opening Bid Unfiltered podcast. Boatwright kept it real on the economic trends he is seeing and how Chipotle will respond.
We have a lot going on in the brand today. We talked about this a bit on our last earnings call, how I believe today the brands that are winning in this very tough consumer backdrop, or the brands that are innovating in a really meaningful way. And so innovation at Chipotle has always been very measured and for many, many years, and it will remain a measured process that we'll always follow our stage gate approach. But I think we need to move up the speed of innovation. And, we had confidence around the Adobo Ranch, which we launched this summer. It tested super well. It went through the stage gate process, held up to our high bar on standards. I think we've talked about this in the past, Brian, where it needs to meet the three greens. It needs to be right for the consumer. It needs to be right operationally, and it needs to be right financially. And so we have moved up what we think to be world-class innovation, and you're going to see some of that play out on the 2026 marketing calendar as we think about, think differently how we reach the consumer in the months and quarters ahead.
Scott, I've covered Chipotle way back to when Steve Ells was getting the company off the ground. It's always had, like any company, has different chapters. Does it feel like you're entering you're at a crossroads now? Not that your brand is hurting by any stretch of the imagination. That's not what I'm getting at. But like, you have cautious consumers, you're working on new technology, you're bringing some more new things to the menu. It just sounds like a very important moment for the company.
Yeah, I agree, Brian. I feel like we're at an inflection point, and the consumer behavior has shifted measurably over the last several quarters. And so there's, it's not new news to anyone that the consumer uncertainty is probably greater this year than it was last year, and it wasn't great last year. And so consumers are being very, I guess, for lack of a better word, choosy about how they spend their dollars, where they spend their dollars. They're looking for value, but they're also looking for value as a price point, which many of the big QSRs and even other fast casuals lean into in these uncertain times. I talk about this often, this idea that value at Chipotle equals benefit over price. And what I want to do, Brian, is really hold price constant, but continue to improve the benefit of the offering for the consumer, which I believe will increase value for the consumer and continue us to lean into our core equities around the value perception at Chipotle, which is really grounded in this idea of high quality, great ingredients, prepared with classic culinary techniques at a speed and price point that is really unmatched.
And Scott, it's not, it sounds more like, the consumer's under pressure. It's not just a Chipotle thing. I heard over at Starbucks over the past few months, every other restaurant is talking about this, but it sounds more like an economic thing. When I go into Chipotle, the food tastes exactly the same as I've went every single time the past 10 years of my life. It's not like you're cutting back on ingredient quality. This is not why maybe traffic isn't as strong as it was a year ago.
That's right, Brian. Based on our data and what we're seeing with the consumer, we're not losing customers. We're losing frequency of those customer visits, meaning the Chipotle fan that was coming 2 or 3 times a week may now be coming once or twice per week. They're still coming. They're still enjoying the great food that they've always appreciated and loved about our great brand. They're just coming less often because I think they're being more conservative on how they think about spending dollars in this really uncertain macroeconomic environment.
I'm looking through the prism of, I work in New York City, I live in Long Island, and there's these new restaurants popping up that I think have seen what Chipotle has done, what Sweetgreen has done, even what Cava. They're still new as well, too. Are these new upstarts taking that extra trip away, and how do you measure the rising competition in some of these big markets?
Yeah, as you can imagine, we follow most of our competitors and other brands, whether they're casual dining or QSR, very closely to understand where are share gains happening in this value-conscious environment where the big QSRs are competing on value as a price point. So think, $2.99 snack occasion, $5 meal deals. They're really trading customers between those brands. What we see in our fast casual segment, particularly, is we continue to move share forward. This last quarter, we saw some diminishing share gains in the May timeframe, where we talked about the consumer stepping down on spending, and we saw that the low-income consumer was really under pressure. But we don't see share gain loss, or share loss, I should say, to other fast casual or even QSR concepts.
You and I have talked in the past, and you've always been proud of, and even prior management, I'm thinking back to Brian Nichol when he was leading the company. on keeping prices under $10, under $10 for a burrito. Even Jack Hartung, when I always talk to him, a longtime CFO, I know he's there in some capacity. But
Jack's the best.
yeah, I mean, that guy is a good dude. But are you at the point now, just given how the costs have risen in the business and the industry, you have to start marketing around things like around $10? Is that like the next frontier for Chipotle, where you just can't keep that $10 price point?
You know, it's a great question, Brian. I think for us is we continue to lean into the offering, whether that's better ingredients, better animal welfare practices, and continue to drive this idea of abundance for the consumer, big, beautiful bowls, big, beautiful burritos, and we can hold price constant because we have such an incredible economic model. Brian, we don't have to make knee-jerk responses or knee-jerk reactions to what's going on in the macro, whether that's cost of goods that may change or tariff impact in the business. As you know, the brand enjoys an extraordinary economic model that drives outsized returns based on our annual unit spend. And so I'll tell you, I say all that to say that I think we're rightly positioned in the market we're in today. We may have to think differently about how we drive demand. But I do think this is transitory. I think once things begin to improve and stabilize in the macro environment, that things will improve.
What do you just have to blister the TV airwaves with ads? I mean, Chipotle has done a fair amount of ads, but is that what you're thinking about? How do you change what you've done?
I think we just need to communicate our value proposition in a more meaningful way in this consumer environment, and then bring forward innovation that is demand driving or demand generating. And based on what we have in the hopper, unfortunately, I can't share those ideas with you today, Brian. We've got some really unique items that are on brand, on trend, that I know will get our core consumer to come into the brand more frequently and drive transactions in our digital ecosystem with our most loyal customers.
All right, the trading day is underway in financial markets. Every second matters. What you do right now can determine your financial future. So here is my forward-looking thought of the day. Trust is earned in life, business, and investing. In investing, if a CEO and a CFO don't deliver up to their often super optimistic outlooks repeatedly, you should view them very skeptically. By that I mean you probably shouldn't invest in the company. CEOs and CFOs have to earn your trust through consistent execution. Let them promise the moon and the stars, provided they can back it up. Coming up, Julie Hyman has you from Market Catalyst. Don't go anywhere.